As the Fed continues its tightening policy, which includes relatively higher costs of capital, cash becomes more scarce and expensive, not just for individuals in the form of higher rates on mortgages, personal loans, and credit cards, but also for businesses, which can see lower sales because of that. And therefore, earnings which may lead share price to decline or lead to inability to service issued debt. That said, businesses with deep coffers have a higher chance of successfully navigating through lower demand cycles compared with businesses that have relatively high debt on their balance sheet. There are several ways to understand the financial standing of a company. One of them is to investigate the balance sheet of companies similar in terms of geographic location and growth cycle. Furthermore, there are ratios that we look into when investing in companies regardless of the intention of investment. One of the most ratios of importance that we look at is something called the interest coverage ratio. This helps gauge the business ability to service its debt with sales generated. And this is especially important when trying to invest in a bond issued by this company, because that helps us understand if it is able to pay for this bond on a short-term basis. Second, quick ratio. Now, this ratio helps understand the ability to pay the company's short-term debt using cash on hand and payments expected to be received within the 12 coming months. We also have current ratio, which helps understand the company's short-term financial strength by gauging whether it can meet its short-term obligation without tapping into its long-term assets in terms of trying to sell something that they own, which we do not want to see. Solvency ratio, this one is the trickiest of the bunch to calculate, but it helps understand the company's ability to pay its long-term obligation. The higher the solvency ratio is, the better. Keep in mind that even when correctly calculated, these ratios alone do not give a full picture of the financial strength of a company. Instead, they help make investment decisions by narrowing down the number of companies in question.